It's really a fun pleasure to be able to host Wendy today, and really something that is kicking off a bit of a focus around sustainability this month at Owen. We'll be talking about sustainable investing today, and then those of you who are interested in this topic know that March 15, we're having an afternoon set of events around energy and sustainability, and so there'll be a couple different panels that afternoon. So if you haven't seen that, be watching for that in Inside Owen or What's Happening, and sign up and join us on the 15th. But it's part of our March focus around sustainability, and it's a fantastic opportunity to be able to kick this off with Wendy, because Wendy is the director of sustainable investment, and in that role, setting the research strategy for the firm's sustainable investment practices. And I think as part of that, is really going to be great for setting up this topic for us. As vice chair, she's also a senior member of the firm's management team and works with the CEO on strategic initiatives and external affairs within the organization. And she also plays a couple other roles in the firm. She serves as chair of the Strategic Relationship Advisory Committee, is on the compensation committee of Wellington Management's Australia board, and is a member of the firm's stewardship committee. So a number of different roles inside of Wellington. Previously, Wendy conducted research on long-term multi-asset themes and led the development of multi-asset portfolios for the firm's global client base as director of global multi-asset securities. She's also served as terms of the executive committee, the hedge fund review group, and the equity review group. So, of course, all those are super important, but the one that we, of course, love the most is that Wendy is an Owen alum, receiving her MBA with honors here at Vanderbilt. Prior to that, she was a BBA at University of Mississippi, and she holds a Charter Financial Analyst designation. So welcome, Wendy.
Hey, thank you. Thanks for having me. I was happy when you said March was Sustainability Month. You didn't call it March Madness.
I often wonder, that, of course, we know March Madness is basketball, but it is kind of like, depending on where you're living in the country, it's a madness, crazy time period, right? Weather or otherwise, right? So good time to be talking about sustainability. Well, let's start, Wendy. I'd love to have you just give us a little bit of your career arc, the story of your time after leaving the Owen School.
Sure. Well, I graduated from Owen in '95, and I joined Wellington in '96. So I had a one-year stint out west in the President's Associates program with Promise Companies, which is now it's, I think, Hilton, but it was one of the partners from Owen. And I moved to Boston in '96, and I've been at Wellington ever since. I didn't expect to be at one firm for the entirety of my career, but Wellington has been that place for me. It's often that place for lots of people. And when I started, I actually started in what was called the Institutional Client Services Group. And my main message for those of you who are getting your MBA now was that I had no idea the arc of my career at that point. I can make it all make sense and give you like a joined up story now, like I was building this skill to do this, to become that. It all makes sense in retrospect, but I actually had no idea at the time. I just followed what was interesting to me and where I thought I could have impact, honestly. And that's what's happened and is how I've worked to be in this position that I'm in today. So back starting in client service, one of the first things that I recognized was that the way we were assigning client accounts was kind of haphazard. We were a much smaller organization. It was based on who had time, somewhat based on geography. And then I had this idea, and I think probably grounded in my days at Owen, had the gumption, if you will, to like propose this idea to the leader of the group at the time, which was if we focused on channels, clients by channel type, then we'd have a better understanding of the problems that they were trying to solve from an investment perspective, and therefore we would be better at solving them. And it would help the firm with innovation on types of strategies that would help them solve their problems. And it would also help the client service people just generally share knowledge and become more content leaders and become more valuable. So that was my key insight at the ripe age of, I don't know, 25. And he liked it, which was great. And so they adopted that practice. And because I had proposed it, they gave me the opportunity to choose which channel I was going to focus on. Not lead it, just where I was going to focus, because I was too young and inexperienced to lead it. And I chose endowments and foundations on the East Coast. And the reason I chose that was because endowments historically have been leaders in what you would refer to as asset allocation or investment policy. They tend to push the envelope, move into new asset classes, and I found that to be really intriguing. So I told that story at the beginning of not knowing where I was going when I started. This was really my first kind of intentional choice because it was an area of interest that then led to my next move. So about a year after that, I became the second member of our asset allocation group. So I'd been focusing on endowments and foundations, investment policy, learning this tippy end of the spear kind of stuff. And then that allowed me to shift into this very nascent asset allocation group, which was exciting and moved me over to the investment side. And then the next thing that happened, this was more fortuitous and lucky, was that in 1999, you may not remember, but there used to be an airline that you've probably seen in the movies called TWA. Anyone nodding? There's an airline. All right, they went out of business. And when a company goes out of business, they still have employees that have a pension. And so those pension assets need to be managed by someone. They were put to an organization called the PBGC, more than you need to know, the Pension Benefit Guarantee Corporation. It's a government entity. And Carl Icahn, who's an activist investor, was part of the settlement. And he said, that's great, but the PBGC can't manage the assets, because he knew they would manage them very conservatively, not for returns, and they would cost him a lot more money. So he made them put out to bid this $1 billion assignment to manage the TWA pension plan. And my co-collaborator in asset allocation and we decided to go for it, to literally like bid for $1 billion. So we're managing $0 and we're going to bid for $1 billion. But we had the strength of this firm, Wellington Management, behind us and all of the aptitude and capabilities there. And because we were small and a little bit, I guess, scrappy, we would just literally answer their questions in a bespoke way. Whereas a larger, more established group would have all of these kind of pre-packaged answers that were polished. But they really liked it that we were looking at their data and being very specific. So that was our kind of key advantage. And they wound up choosing us, which was amazing. And the lesson, I guess, there for me was this is a really interesting way to manage money. To really, and again, it ties back to that whole client experience, right? To really understand the problem they're trying to solve, and then to really try to answer that problem in the investment solution. So that was a nugget of an idea. And then we began to build a whole capacity around that. And we grew that area of our firm to about $30 billion over the course of the next 10, 15 years. One of the areas, skipping forward, I won't bring you through all of it, but one of the areas that we focused on, now it would have been 7 years ago, was this concept of impact investing, which is healthy in the private investment arena, but nobody was really doing it on the public side. And the insight there was, okay, you can solve clients' problems, but you can also solve world problems through investing. And that trying to do that in public security stocks and bonds could be kind of interesting and appealing. And maybe that's a way of the future. And so about 7 years ago, we launched a public securities impact portfolio. And then about 3 years ago, our CEO said, well, Wendy, you've got this multi-asset. I was equities, fixed currencies, derivatives, all that stuff. You've got this multi-asset expertise, and you've got some, not a lot, but some impact expertise. And we need someone to really bring together all the threads that are happening across sustainable investment at the firm, because we're a very bottom-up, organic, not top-down strategy-oriented place. And so that's how I wound up where I am today. And again, it's a little bit just building skills and finding things that interest you. I can make it make sense looking back, but looking forward, I had no idea where it would take me.
That's great. I appreciate your honesty on that too. That's, because I think so many times for our students, they're kind of looking down the road at 20 years of career, and it sometimes can seem like magic. How does that all work? So awesome to hear your story. Well, I do work with people.
I do work with people who are the opposite. They've known from birth that they wanted to be a healthcare analyst, and they are a healthcare analyst for the entirety of their career, and they're excellent. So obviously, there's multiple paths, but that was just mine, a little less specific.
Got it. Well, I think we need to step back and define sustainable investing to start with. So can you help us with a bit of a definition? What are we talking about here? What does that mean to you?
Sure. And I gave you one definition of a part of the sustainable investment ecosystem, which is impact investing, which to us means investing in solutions. Importantly, maybe to this business school crowd, all of this, at least in the way that we approach it, is meant to be non-concessionary, meaning we're trying to beat benchmarks, we're trying to provide excellent investment results. And so it's sometimes people will say we're not trading values for value, things like that. But basically, what I would highlight to you about this whole area of sustainable investing is that it is rapidly evolving. It is a paradigm shift we're seeing in capital markets. And because of that, there's a lot of opportunity. There's also a lot of challenges, and there's a lot of inefficiency. So to the extent that you're in any of the finance classes and you're talking about market inefficiencies, this area is complete with tons of market inefficiencies. The data is highly imperfect. There's no consolidation around definitions. There's no consolidation around disclosures. There's no really unifying investment philosophy. So all of those things that you look for in terms of seeking market inefficiencies in order to generate alpha or add value are here. And then the other thing I would say is it's really important when you're starting on your investment career to try to figure out your edge, which often has to do with some lens that you're applying to look at securities in a different way. So sustainable investing often offers that as well. So inefficiencies and a new lens. So if you're interested in investing, I encourage you to look at this space. Most people would associate sustainable investing with something like negative screens or SRI, socially responsible investing. And for a long time, that is what this meant. But it has evolved pretty significantly. That was a limiting feature, I would say, of the space, because a lot of people can't agree on what they don't want to invest in. So I'm looking at all the screens, the faces on the screen, and maybe Madeline doesn't want to invest in alcohol, but Drew doesn't want to invest in tobacco, and Colin doesn't want to invest in fossil fuels, and Dean Johnson doesn't want to invest in sugar or something. But Madeline actually, her brother works for a gas company, and Dean Johnson likes to have a cocktail or whatever. You can see how there were all of these circular conversations around when you just defined the opportunity set by what you weren't going to invest in. Very difficult to agree. And what you find now is that the whole kind of, that there is a function of the market that is still oriented around negative screens. But more often than not, it is about positive inclusion. So what are you going to invest in and why? And so when I, talk to a potential client about some of our strategies, I will say, are you interested in investing in companies whose core goods and services are targeting the world's biggest problems? We think they're underfollowed and underpriced. And they'll go, yeah, sounds interesting. All of those people who were just arguing, well, they can agree that, well, that could be an interesting strategy. Or are you interested in investing in companies who have high return on invested capital and best in class stewardship that compounds that capital through time? They'll go, that seems sort of sensible. Let me tell you more. Let me hear more. So moving away from that negative screening to really talking more about the types of characteristics you're seeking in the investments that you would make. I'm going to throw a bunch of terms at you, which could be painful, and you don't have to remember them. Actually, we're going to send out the slides afterwards, and they're all in the slides. But one term that you will hear, and you may have heard it in some of your courses already, is ESG, environmental social governance integration. And that is trying to reflect the fact that when financial accounting came around, our economy was pretty different. It was based in physical assets. In fact, tangible assets made up the majority of the market value of most securities. And through time, we've evolved as an economy where physical assets are less important, but our financial statements haven't evolved with us. And so if you're doing income statement analysis and financial statement analysis, there's only so much you capture on a balance sheet or an income statement. And so ESG is meant to capture and help you think about the other stuff. The environmental consequences, social consequences, and governance consequences or practices of a company, which can add to or detract from value. And so that's what ESG integration is okay, what are these folks doing and how does it add to value or detract from value? So an example, a pretty simple example that falls into the S category is cybersecurity for, say, a financial payments company. Do you want your financial payments company to have a strong cybersecurity program that's invested in and good oversight, or would you rather them, not really think about it? Probably the former, not the latter. So digging into that, with the management team and understanding what they're doing to protect data or otherwise is really important. Or even in the energy space, E&P companies are pretty water intensive. And some of those companies have invested in water recycling facilities. And so all things equal, they have lower water costs and lower production costs and therefore higher profitability, all things equal. Obviously, that's not the only thing that matters. Or vice versa if they haven't done that. So you want to factor that into your DCF or whatever you're going to use for your valuation tool. So that's ESG. And then engagement means that as an active manager or as a manager in general, you can sit down with the company management team or their board and talk to them about their practices and try to influence better outcomes for shareholders and beyond. There's a category of thematic investing. That's exactly what it sounds like. So it might be investing in a climate portfolio or in a water portfolio. I just use water as an example, or in a gender lens portfolio. Impact investing, to us, that's investing in companies whose core goods and services are solving these world major problems, life essentials, human empowerment, the environment. And then there's another term that's a little bit that you, if you get into the space, you'll become very familiar with very quickly, which is called SDG investing. So the United Nations in 2015 laid out 17 sustainable development goals. And SDG investing is investing against those goals to try to achieve them through time, roughly speaking. Any questions on that?
That's great.
Okay.
That's great. Well, given all that, I mean, you talked a little bit about this with your career arc, but what drew you to this space? I mean, it's clearly an interesting and evolving space, but for you personally, what drew you to the space?
Well, it's at the time I was managing this other group, this business that that we basically started from scratch. So it did feel like, you know, moving away from one of your children to move into a different area. But there was something about the challenge of kind of trying to do it again that I like, just like from a challenge perspective, you know, so we got to 30 billion in multi-asset. I hope to come back to you in 2 years and say we've gotten to 30 billion in sustainable. We're at about 6 now. So I've got some work, but there was that challenge aspect of it. But really the thing that drew me to it was, you know, I was opining, I have children, and I was opining to my children, as a mother will often do, in the car about this and that, and this that needed to, you know, be improved upon, and that needed to be improved upon. And my son, who would have been, now he's 14, he would have been 10 at the time, said, well, why don't you do something about it? And I was like, ooh. Wisdom from a 10-year-old. And that really got me thinking. And so when, you know, Brendan presented this idea, I was keen to jump on it, even though it felt like, you know, my whole career was in this macro multi-asset area. I think that's what compelled me to do it.
That's neat. Well, let's talk a little bit about the climate science piece. And I know that Wellington has the Woods Hole Research Center that's really focused around how to integrate climate science into asset management. So I thought it'd be great if you could share a little bit about that.
Sure. I mean, when people ask me what's most differentiated about how we approach sustainable investing, there's 2 areas that I highlight: impact, which I've talked to you about, and then this physical climate research that we've been doing. And back in 2018, we looked out into the marketplace, and there's a lot of climate research that happens in finance, but it's all around a specific topic, which is climate transition. And maybe MK, can we put the slide up now, or that might be helpful. But climate transition, or Sharon, climate transition is all about emissions. So look at the left-hand side. Climate transition risk is what most people were studying. It's about the cause of climate change, the emissions, which companies are emitting, how much are they emitting, will there be policies and regulations to change that profile or behavior? Will there be technological disruption to change that? Will there be litigation? Will societal pressures change? Consumer preferences change? And inherently studying transition risks is somewhat behavioral, right? Will a person do this? Will a policymaker do this? Will a consumer do this? Will we make different choices? Incredibly interesting, incredibly important. But what we also observed is that nobody was studying the right side of this page, which is actually the physical risks of climate change. So heat, drought, wildfire, hurricanes, floods, access to water issue. And people weren't really factoring that in. And so we decided that we really wanted to try to study that and see what the consequences of those physical risks would be on societies, economies, and companies. So if you fast forward to the next slide, we looked at some vendors, but ultimately we decided that a research partnership was going to be more robust. And we began this multi-year research collaboration with a group called Woodwell Climate Research Center. And Dean Johnson referred to them as Woods Hole. That actually is what they used to call themselves. And to make things confusing, they changed their name about 6 months ago. So Woodwell Climate Research Center. The whole goal of that partnership is to bridge the gap between climate science and finance. And really, I tell this story, which is a true story, but I just think it's so emblematic of that gap. We sat down with Phil Duffy, who's the head of Woodwell Climate Research Center, brilliant climate scientist. And we said, we want to understand heat, drought, wildfire, hurricanes, floods, access to water issues in basis points, which is obviously a finance term. And he said to us, what's a basis point? And so that light bulb went off at that moment, like, okay, he doesn't know basis points. We don't know RCP scenarios. Like, we should be like working together. And it's been incredibly impactful in a very short period of time. Again, I thought we were working with a think tank. I thought it'd be very slow. we've driven towards a lot of investable insights in a short period of time, and done other things based on this work as well. So if you go to the next slide, I'll show you kind of how it works. I keep mentioning those variables, and I have the 6 sort of memorized, and then we've added 2 more so they don't fall into my my language as well. But sea level rise and air quality are the 2 additional variables. But heat, drought, wildfire, hurricanes, floods, access to water, sea level rise, and air quality, where are those things going to be more intense, and when is that going to happen? And how will that affect the companies, economies, and overall society? That's the goal. So the very first variable that we decided to study was heat. And the way it works is they give us a huge literature review. There's a lot of peer-reviewed literature in all of these areas of established climate science. And they know what's good. They know the best of the best. So they give it to us, and we have exactly 1 week to read thousands of pages. So it's like you're back in school again. And then we come back and we meet with them and we say, okay, based on our very, very small amount of knowledge, we think these are the types of capital markets questions we're going to want to answer. And then they say, well, if you want to answer those questions, then we recommend this type of metric. And so ultimately for heat, I left out a slide, but we determined that the right metric to use would be an intersection of temperature and humidity. And I grew up in Louisiana, so my mom was right. She always said, you know, a wet heat is hotter than a dry heat. That's actually true. It has more effects on the human body and more effects on infrastructure. So looking at those 2 things at intersection were really important. So then they go off and then they create all of these granular grid maps. This is obviously not a granular map. This is a global map, but the heat maps are about 100 kilometers by 100 kilometers. And they show us time period over time period, how that's going to change. So looking at this map, the first map that we got was the map of the US. Actually, if we go 1 slide forward, well, no, stay here, was the map of the US. And you get a little bit distracted by all the red that you see in Brazil, which is important. That's the Amazon. But the US actually has a lot of variation in it as well. So if you look at someplace like Houston, Texas, you'll see that Houston, Texas is going to have 2 additional months of extreme danger heat days, danger and extreme danger heat days annually, unfolding in the 2020 to 2029 decade, which is obviously now. So one of the pushbacks that you sometimes get with climate is it's too far out to matter for my investment thesis. But this is now. And so we quickly learned, okay, that's more of an impact than we thought, sooner than we thought. And then the question was, well, I wonder if we're late to this game, like maybe everybody already knows this. And so sometimes investing can be science, but it also can be a little bit of imagination. If you go to the next slide, our test to see if it was priced in, if you will, if the market already knew, was to look at municipal bonds. We thought, well, municipal bonds are inherently place-based. You're financing a location, a project within a location. They're long duration. They're relatively well traded. Can we find 2 bonds that have basically the same financial characteristics? And you can see those here, the same credit rating, yield, and maturity date, but very different climate outcomes. And this is a case where we did find that. The Texas bond, Texas, is priced the same way as the Michigan bond, but you can see that the Texas bond has a lot more climate risk, both from extreme heat. Now we also know from extreme cold, but extreme heat and from hurricanes. So we layered on the next variable later on once we'd done that research. And so if you're an investor and you're investing in a municipal bond portfolio, why would you buy bond number 1? You can choose. You'd only buy bond number 2. And so from an investment standpoint, that's a really interesting insight. But beyond that, and we can take the slides down. Beyond that, it doesn't only apply to fixed income. We've also translated the research to other areas, particularly places where there is a physical orientation to the value of the security. So just changing the mindset of investors and thinking about, does location matter? Does a physical asset matter? In that case, maybe climate matters, depending on the location of that physical asset, to the security. So REITs, obviously real estate, obviously property, infrastructure, things that are very obvious. We did a whole project on theme parks. This is not changing the world, but understanding how theme parks are going to be disrupted. We've done a lot on agriculture, understanding the implications on agriculture. We've done projects on climate migration and on water scarcity based on this work, all with investable insights of one type or another. In addition, once you understand the consequences, you also feel really compelled, I guess, to share this insight with lots of other people. Because, okay, fine, if we do well for our clients because we avoid the Texas bond, but like, what about the, just life? Then maybe they have more money in their pension plan, but there's no place to live. And so we do a lot of work with companies and governments so that they better understand their exposure, so that they can try to adapt and build resilience. And then we also, just recently joined in December, we were founding members of something called the Net Zero Asset Managers Initiative, which is a commitment by our firm to be net zero in everything that we do, including our investment portfolios, by 2050. So that would be in line with the terms and agreement of the Paris Agreement. And we can talk more about any of this, but I've probably gone on too long.
No, that's great. I mean, I was thinking about your specific case there, the Texas bond. And is there also an argument that if the market's pricing that appropriately, it'll drive solutions to some of the climate changes?
It's a great question. I love that you asked that question, because sometimes people will say, well, don't you feel badly? Like you're exposing all this information. I was like, well, we need to know, right? We do feel badly because we're not always coming with solutions. Like it can be a very stressful job in the way that you get exposed to information that you wish you didn't know, for sure. But you can like ground yourself in the fact that I'm doing as much as I can to be, part of the solution by exposing the information, exposing it to the companies, getting them to think through the implications, helping them build resilience, helping identify solutions. And we're definitely investing in solutions to various issues as well as part of this, because they're actually great investment opportunities. And it also helps you get over the stress of identifying the problems in the first place. But yeah, I mean, that market signals are really important. And I think, a lot of people, when they think about finance, there was a bit of a backlash to the GFC where people are like, ooh, finance, I don't want to do that. That's bad. But capital markets can solve problems. They just need to be used correctly to solve those problems. That was the original intent. So we're definitely seeing a reshaping of capital markets today.
And when you think about, this space and how people are investing around sustainable market opportunities, do you see it changing? I mean, is the puck headed in a direction that's going to cause what you do to change or think about the problem? Yeah,
so there's a lot of change, sometimes internally. So we're a Boston based firm, but we've got a global footprint. So we manage about 1.3 trillion in assets, and we've got 16 offices. And if you think back to your courses on product lifecycle adoption, where you have the innovators, I'm hoping to see some nods, the innovators, the early adopters. You guys could probably remember it better than me. Early adopters, early majority, late majority, and laggards. And you have that kind of adoption curve. And as you have more people in each of those categories adopting the new iPhone, then you've got greater market share. Okay, so you can apply that same concept to sustainable investment concepts, but do it by geography. And so the Nordics and the Dutch were really the innovators. The UK and Europe were early adopters. Canada, Australia, early majority. I'm going to be provocative now, and hopefully you'll allow me to be so. I would say Japan and China a late majority, and then the US and Southeast Asia. I have no idea about Latin America. I need to go spend some time when we get out of lockdown in Latin America, but as laggards. And so in the US, particularly as investors, we're so used to thinking of ourselves as leaders in capital markets, and innovators in capital markets. And in this area, we've been late. And so that's been a bit of an impediment, whereas the rest of the world is on this. I mean, like you go to Australia, all of the clients there, all of the big pools of money, they've already carbon footprinted their entire portfolio. They know what the emissions levels are. They know what they want them to be. They know that they're going to hire or fire managers based on that. I mean, it is a well-developed practice. Not that there's not more work to do, but in the US, we just been a little bit later. And then last year, there was some activity that was, maybe moving in the opposite direction in the fourth quarter by the DOL. I don't know if you guys study regulation, but the DOL, the Department of Labor, and the SEC a little bit not so supportive. And then we've seen, of course, a complete reversal on climate in the last 2 months. And so the US is flipping not only to be in line with other markets, but to accelerate. So that'll be, when you talk about change, I think that's going to be the biggest change. Europe is in a very European way. They've got a whole action plan to transform finance. I mean, like every week I feel like there's another 300-page regulation that comes out. That's all part of this grand plan to transform finance, which is great because it's accelerating activity, and it's also hard because it's 300 pounds of regulation every other week. And so they are making it happen. Now, would I do it exactly the way that they're doing it? Not always, but do I appreciate that they're a catalyst? Yes. And so those are probably two driving forces. The overall driving force has been climate and more understanding and receptivity to the fact that the climate is actually changing, and we need to think about that. And then a lot of people, I think, in this past year, early on, well, actually, let me take a step back. In previous iterations, sustainable investing or socially responsible investing that was based on exclusions, when you had a market downturn, people suddenly didn't care so much about whether or not you bought this or that. It often reverted back to just give me returns. And so the way that it's evolved to be more focused on financial incentives and returns and the types of securities that you're going to buy versus those that you're not has really helped with that. But then I just think awareness of climate, and then one of the I hate to say it, but silver linings of the pandemic has been the realization of all of us that we do face systemic risks that are outside of our control. And so that has also helped people to kind of lean in, CEOs to lean in, investors to lean in, to try to understand and think about the risks that we may not always think about when we're looking at an income statement.
Has COVID accelerated any of this or changed the change?
It definitely has. Well, one thing is securities that would be reputed to be best in class on a sustainability dimension have typically outperformed during COVID. So I will acknowledge that. I think it's beyond that. I don't think it's just that, but I think the mindset has changed. So what I see in the company meetings that we do is when you're in the midst of the crisis, you're no longer asking about the next quarter. That's the whole tone of the conversation takes a different path. You're more asking about the strategic plan, how what these companies are doing to protect their customers, what they're doing with regard to compensation, how they're thinking about furloughs, all of these things that can have a longer term orientation to the trajectory of the company, because analysts know that they want to understand the company during crisis. It's a great time to understand the actual culture, the actual strategy, and get some view into their future. So you get a little bit less like, are you going to make the corridor, and a little bit more focus on longer term issues. So that's been a mindset shift, I think, during COVID as well.
That's neat. Well, I'm going to open it up here for questions from our audience here in a minute. I have one last one for you that's maybe a little more personal to Vanderbilt, or at least to universities in general. Is, you know, you've talked a lot about the shift away from negative screening and towards kind of positive inclusion. But as you know, right, universities, endowments everywhere are facing calls all the time for essentially negative screening, whether it's private prisons or carbon or whatever it is. You know, there's going to be a set of folks on campus that are demanding that we shift our investment strategy. But how do you advise your clients like us in those circumstances?
Yeah, well, the most common call for negative screening is around fossil fuels. And a lot of endowments, I can't remember if Vanderbilt's done this, I should have looked it up, as a first step have divested from thermal coal. I can't remember if Vanderbilt's done that or not. I'm sorry, I should have looked it up. But and the reason that they did that is they wanted to make a gesture to the demand. Thermal coal is not great, right? And thermal coal doesn't have a long-term future from a value perspective. So it like just works all around to divest from it. But also thermal coal is like 0% market cap in the index. So it also doesn't really matter. And maybe I'm being a little cynical. So endowment investors know, okay, well, the students don't want us to invest in fossil fuels. Energy, you know, it used to be 30% of the index. That's too much. We're not sure. We don't want to give up those returns. What if, you know, you get a bid to oil? We'll divest from thermal coal and we'll say that that's a step. So that's a little bit of a cynical interpretation. It is a step, and it also is a small step. What's happened that's super fascinating is energy is now about 5% of the index. And what you've seen now that energy has underperformed for such a long period, since 2015, really, that you're seeing more and more commitments from endowments and other investors to move away from energy. And I think part of that is recognition that it's not as big of a part of the index anymore. It's also recognition that we are seeing a transition to a low carbon economy. It's already underway. It's only going to be one direction. So what is the long-term value of those companies? If they don't have a plan, the long-term value is not high. So, but my preferred approach, even having said that, my preferred approach for all of this is through engagement. So our whole strategy for the outset, these outer years of the net zero commitment, is if we can get all of the companies that we invest in, all of them, which would never happen because it's like everything, but if to set science-based targets, basically to have a low carbon transition plan, then we're done. There's no exclusions, there's no selling, there's no limitation to opportunity set. You're decarbonizing society, you're decarbonizing your portfolio, you're insulating your clients' assets from carbon risks. So that's our primary approach, rather than saying, you know what, in all of our portfolios, we're going to sell out of all of these companies, any of them, because what we've learned through the physical climate risk research, as I mentioned before, is even if you sell all of the emitters still exist, and you're not insulating your portfolio from climate risk because it will come back in the form of physical climate risk. So you're not actually solving a problem, but you may temporarily be making yourselves feel more aligned. So my preferred approach is, we're big, we're an active manager, so we buy and sell securities. Companies generally want us to buy their securities rather than sell them. Let's talk to them about this. Let's talk to them about why we think having a transition science-based target transition plan is important to their long-term value, and see what we can do. So you'll see us doing a lot of that.
I love it. Thank you. That's great. Well, MK, do we have some questions from the audience?
Yeah, we will open it up. If you want to unmute your microphone and ask a question, you're welcome to. So I'll throw that out there first and see if we have anyone that would like to ask a live question. Otherwise, we can go to a few from the chat. All right. So first question, since Sustainable investing is an intersection of science and business. Do you see there being increased correlation in the future?
MK, you broke up for a second there. Something about the science and investing. Do you see something in the future?
Let me read it again. Sorry.
I missed the question.
Since sustainable investing is an intersection of science and business, do you see there being increased correlation between those in the future?
Great question. Well, I mean, certainly all of our climate work is informed, or all of our climate investments are informed by science. And then people, you know, sometimes I like have these remarkable observations, like it's almost out of body. Like, so we were looking for someone to work on the team, and people that you never think, you know, you're going to be looking for. I was looking for a geospatial engineer. So Dean Johnson may know what that is, but I didn't know what that was, you know, 2 years ago. But geospatial engineers are people who allow you to look at maps and data at the same time, basically. So we have been actively investing in data science and investment data scientists, including on the sustainable investment team. But we're pretty consistently, in general, we're not always hiring just finance people, because I think in order to be effective as an investment management firm, you need a pretty rounded out skill set.
Great. Another question we had in the chat here is, what advice would you give a publicly traded company trying to improve its ESG effort? Some companies' ESG effort is led by investor relations. What advice would you give an investor relations lead?
That's a great question. Well, so in ESG, and remember for those who are just less familiar, environmental social governance practices is what we're talking about. Governance would be capital allocation, remuneration, your boards, that kind of stuff. S would be labor practices. I mentioned cybersecurity, supply chain falls into S. And then E would be more about your emissions profile, your physical risk, your transition risk, et cetera. So just to give you a mental picture of all the stuff that fits into those categories. So there's a concept in ESG that's called materiality, which means that certain things are more important to certain companies than others, or certain industries than others. So as a finance firm, or as an investment management firm, you know, what is most important to us in terms of our success is our people and our culture and our governance structure. It's really that intellectual capital. And although it's important, and obviously I'm in this field, it's important to recycle or, you know, have a low, our carbon footprint's low, right? Except for our travel, which is now also low. But so it's a little bit, the E factors are a little bit less important. But focusing on these other factors are really important to the long-term value we create, and how we show up as a company. So I guess my advice to a company would be to figure out what's most material and drive that performance. And in fact, there's a good amount of research that supports that. And there's also frameworks that support that. But one of my favorite studies is by George Seraphim at HBS, and it's called First Evidence in Materiality. And it basically says companies who perform well on their material ESG metrics also outperform by a wide margin. Now, interestingly, companies that perform well on all ESG metrics over that time frame outperformed, but the ones that also focused on the immaterial and the material, they didn't do as well as those that focused on only the material. So there is a capital allocation question, like where do I spend my time and effort to really accentuate my practices?
Great. I was given it a moment to see if we had any live questions. Feel free to jump in if you do. All right, another one I have submitted. Oh, go ahead.
MK, I forgot the second part of that question.
Sure.
Which was, it said sometimes companies have the IR person focus on ESG. Is that the right thing to do? Clearly not. Like, if you think that it's a driver of value, then you need it kind of integrated throughout your business, right? You need it to be integrated within your operations. And you also need it to be an area of focus at the board. So earlier today, I was meeting with the former CEO of Vanguard, and Bill McNabb, and he's on the United Health board, and he's taking over the ESG oversight position within that board seat. So that's best practice for sure.
Great. And then I think Colin had a question. If you want to go next, Colin.
Yeah, it was actually just following up on something you just said, Wendy, and thank you for joining us. For studies that are looking at performance of ESG metrics versus, returns versus the total market, isn't it a bit of a chicken and the egg problem where firms that are performing financially better are able to dedicate more focus to ESG practices? So, you can't really necessarily draw a correlation of we're doing ESG, therefore good. It might be good, therefore ESG. I'm just curious your thoughts on that and what maybe the literature says.
Yeah, I mean, there are thousands of studies, and the majority of the studies are pretty supportive. They're not all equally robust from a statistical standpoint. I would say a lot of the studies actually focus on scores. So there's also third-party vendors out there who create scores of companies. So your question kind of, I think, is predicated on the fact that everybody agrees on what a good ESG company is, and the scores would suggest that that's not necessarily the case. In fact, there's a professor at professor at MIT, Roberta Rigobon, who has a whole kind of big data project, and the title of his project is called Aggregate Confusion. So that tells you the answer. Basically, he's looking at all the vendors, and there's no correlation among their scores. So, people will ask me about the scores, and well, if the scores don't agree, doesn't that mean ESG is nonsense? I think about it as those vendors, they're providing a service in terms of exposing data, and then investors have to figure out what's important through your lens of investment philosophy and process, what market inefficiency you're seeking to exploit, et cetera. Nobody, well, they will also ask me, well, won't all the scores converge? I'm a little bit cynical, I guess. I didn't realize that, but a little bit cynical in that they have really no reason to converge. And no one would expect Goldman Sachs and Morgan Stanley and JP Morgan to converge on their recommendations on a security. So why would you expect MSCI and Sustainalytics and Vigeo Eiris to converge on their recommendations on a security? They're looking through different lenses. Nor would they expect Wellington Management to say, oh, I just do whatever Goldman Sachs says. That's just, you would fire us if we said that. So the way that we think about it is we use all of this as inputs. Like, it's somewhat determinative of what different people in the market think. The data, as I said before, there's no consolidated reporting. There's no generalized standards. So they're all exposing different elements of data. And then you as an investor have to figure out what you think could drive the stock. And then very specifically, or bond, very specifically on your question, Colin, there are studies that suggest that it's not only best in class companies that can compound value via these practices, but also companies that are bad getting better. You can see outperformance there. There can be pockets of alpha there too. So it's not necessarily, even if everyone agreed, it's not necessarily a chicken and the egg that only the good companies can invest, and therefore, although that is a philosophy, one of our teams very expressly has that as a philosophy too.
Great. Any other live questions? Feel free to raise your hand or unmute and jump in.
Yeah, I have a quick question. Sorry, it's Ian Harris. Hey, Wendy, thanks for the presentation. Really good. I had a quick question, actually very timely. Today in the FT, Chris Hone from TCI is talking about companies make improved pollution disclosures. I wonder what Wellington's position is on the level of disclosure from companies and whether that will assist this sustainable investment push.
Yeah, I think, if you asked 100 people in the field what the biggest problem is, almost all of them would say data. it's a problem. It also can be right now a source of, if you're focused on investment returns, it can be a source of inefficiency and edge, if you will, because I mentioned before, we're big, so we can meet with all of these companies. We have access to these corporate management teams and boards, and we can ask them the questions. Like if there's something we want to know, we can just ask them, how do you think about this? How do you think about that? So I try to embrace the messiness and the lack of data really, really positively. But in order to really transform the economy, we're going to need more information. There's, in these circles, there's a project that's referred to often as driving meaningful data. And I'm on the board of a UN-based organization called the UNPRI, the UN Principles for Responsible Investment. And they're very heavily involved in this, trying to bring together groups of industry bodies to create a global standard. And for those of you who are studying the field, my guess is, I could be wrong, the IFRS is partnering with SASB, the Sustainable Accounting Standards Board, and my guess is that's the direction of travel. But there's also competing projects to drive meaningful data, to drive consolidation. So you've got more than one project trying to do the same thing. So you have to kind of figure out who you think is going to be the winner. The other little twist in that, this is really kind of nerdy SI stuff, but is that SASB is very much focused on financial materiality, which is how I've really kind of talked to you today about thinking about how all of this can drive long-term value of the security. And generally, long-term value and stakeholder interest converge. It's when you have a really short time horizon that those things can be very different. When you have a longer time horizon, those things typically converge. But there's another concept called dual materiality, which would be reporting on pure sustainability metrics and financial materiality metrics side by side. And so there's an element, Europe may go that way, and the rest of the world may go this SASB IFRS financial materiality way. So we may not get full global convergence, even though there's a push to get that.
Great. Well, thank you for the amazing questions. Thank you to Wendy and Dean Johnson for hosting today. I'll turn it back over to Dean Johnson if he just wants to say a quick closing.
Awesome. Well, first of all, as I said at the onset, March is a sustainable month for the Owen School. And if you're interested in this topic, we'll be doing a number of panels on it on March 15th in the afternoon. So be watching for some of those panels as they come along. But it's been great to have Wendy kick that off. And I think she's really opened up a really great conversation this month. So grateful for that, Wendy, and grateful for all your support for the Owen School. Wendy's a really active member of our alumni board and really, in many ways, lives exactly what she was talking about, stepping in and thinking about inclusive excellence and how you bring inclusion to a topic versus exclusion. And even in their own investments here at Owen in terms of building scholarships, really a positive step to help us be a more inclusive school. So we're so grateful for that, Wendy, and delighted that we had you here today.
Thanks for having me.